In this lecture, we're going to talk about an important concept in understanding managerial accounting, and that is that managerial accounting is very different from the financial accounting that you might have taken in the past. So, the financial accounting that you took in the past, where you built financial statements like income statements, balance sheets, and you had to use what they call GAAP, or generally accepted accounting principles. That's very different from the managerial accounting that we're going to be doing in this course. And the most important and the key difference between the two is who the user is. So the user is the key difference between these. So the managerial accounting focuses on a user that's internal. So by internal users, we mean managers, employees, people who are associated with the business because they have some type of job or some type of contract with the business. Financial accounting focuses on external users, right? By external users, what we're talking about are chiefly focusing on investors. By that I mean shareholders, stockholders, and creditors, banks or other lending institutions, or really anybody who lends the business money. So the user really creates all the differences between managerial and financial accounting. Remember, financial accounting is designed to provide information to these people who are external to the business, meaning they don't have access. So remember that they don't have access. Internal users use the managerial reports. So these are like managers and employees. They have access to the information because they work there, and they have the ability to get to information that external users don't. So the managerial reporting, the purpose is to create reports and provide tools for the managers, for the employees and managers. Remember, a manager is just an employee. And financial accounting, we're going to be creating financial statements. The income and statement and balance sheet. All right, so again, the users are what's generating the differences between these two. So the financial statements are created using generally accepted accounting principles, or GAAP. In other words, this is a standard that must be met. There's no flexibility in creating the financial statements. If you remember from financial accounting, income statements and balance sheets have to be done in a very specific way. You can't make them based on how you would like to make them. Whereas management reports, we don't have to worry about protecting external users. We don't have to worry about protecting people because they're internal and they have access, right? So there are no strict standards. And that allows managers to have flexibility to do things the way they want to, because investors and creditors aren't depending on those reports. Those management reports are not available to external users. They're only available internally. We should add that. And because of that, we don't have to protect anybody. We don't have to protect the shareholders. We don't have to protect the banks, whoever's depending on the reports, because they're not using these reports. They're using the financial statements. Because the financial statements are being used by external users that don't have really a way to check to see if the numbers are accurate, they must be audited. So a third party goes in and double checks to make sure that the financial statements look the way, I should say they represent the business. So in other words, the income statement and balance sheet show the business in their true light. That's what the independent auditor has to do. So with managerial accounting, we don't have to worry about protecting the investors and creditors. Since we don't have to worry about protecting them, there's no need for independent audit. Now there may be an internal audit and things of that nature, but that's different from the need for an independent audit, which is necessary for financial accounting but not for managerial accounting. It's very important to understand this, and if you think about it, every single one of these we've talked about so far, these differences are all derived because of the users that we're focusing on. The financial accounting reports, the income statement and balance sheets, you may recall, are based on what they call historical basis. In other words, we're looking at things that happened in the past. So you could also include that, kind of focus on past activity. So think about it. You do the balance sheet, you're doing it for previous years or previous months. You're not doing the balance sheet for next year because it hasn't happened yet. However, with the managerial reporting, we're going to project forward. And the reason for that is because managers want to make decisions today that that are based on what they think will happen in the future. What happened in the past is of no relevance to them. Right? I mean, what happened in the past happened in the past. It's already occurred. Managers want to make a decision today, and they want to make the decision based on what they think is going to best benefit the business in the upcoming future. So they're going to look at reports, management reports, that are estimating what is likely to occur or what is projected to occur in the future. So there's a more of a forward or focus on, let me put that in here. So there's more of a focus on the future. Financial accounting makes reports that are done at specific times. Definitely done annually. They are often done quarterly. By quarter, I mean 3 months. January, February, March would be 1 quarter. 1 quarter of the year, and even monthly, depending on the business. But these specific time frames are when the financial statements would have to be done. With managerial accounting, however, these can be done anytime. Remember, management has flexibility. So anytime managers want them, then we can do them. So that's another huge difference. And again, why does that difference exist? Because of who the user is. External users are looking for information at specific time frames so that they can make their decisions as an external user, right? An internal user might have decisions coming up at odd times. They might be thinking about building a new factory, and that happens to be in the middle of May, for example. So they want reports at that point. They don't have to have the reports annually, quarterly, and monthly. They can have them when they need them. That flexibility is a key element, right? We'll put that here. It's a key element to managerial accounting because the internal users are allowed to be flexible since we do not need to protect them because they have internal access. Financial accounting, though, does not have that flexibility, right? We've already talked about this a little bit. They must follow standards. In the reporting. They're not flexible in the reports because the external users need to know the exact way the financial statements are going to be made, when they're going to be made, and how they're going to be made so that they can use them as external users. Because they're external, we need to protect them because they don't have access to the information. They're not insiders. And another difference that we have between these two is that in financial accounting, we had to make the reports based on the entire business. However, in managerial accounting, we have flexibility depending on how managers want to see the reports. Maybe they want to see them by product. Maybe they want to see the reports by geographic region. In other words, the north, the businesses in the north, businesses in the south, businesses in the east, so forth. Maybe they want to see the business split up by departments, or maybe they want to see the businesses split up by segments. And I'll just put etc. because managers can split the business up and look at reports any way they want. Maybe they're thinking about expanding their line of sporting goods, but they're not really worried about their other lines of products. So they want to get a report just on the sporting goods. They can do that in managerial accounting because they're allowed flexibility, again, because the internal users have access and we don't need to protect them. However, with financial accounting, we can't just pick apart the business and report any piece we want. We need the investors and creditors to know about the entire business. So make sure you have a thorough understanding of the difference between managerial and financial accounting. I'm going to tell you it's very important in this class that you know the difference between those two.